You've seen the headlines, haven't you? 7000 silver, Ray Dalio's secret bet. It's an electrifying claim that has bounced around the internet, fueling speculation and capturing the imagination of investors everywhere. It suggests one of the sharpest financial minds of our time is secretly positioning for a massive game-changing explosion in the price of silver. But there's just one rather significant problem. Ray Dalio never said it. That's right. As far as public records show, the founder of the world's largest hedge fund, Bridgewater Associates, has never predicted that silver will hit $7,000 an ounce. So where did this explosive claim come from? And why has it gained so much traction? In this video, we're going to uncover the real origin of this viral prediction. But more importantly, we're going to get into the much scarier and much more important economic reality that Dalio is actually warning about. It's a truth with far greater implications for your money, your savings, and your future than any single price target for silver. The story behind the 7000 silver myth is actually more fascinating and more frightening than the headline itself, because while the number might be fiction, the fear that powers it is very, very real. What Dalio is truly saying could change how you see the entire financial system. So, if Ray Dalio didn't say it, who did? And how did his name get attached to such a specific astronomical number? The answer isn't in a secret memo from Bridgewater, but in the world of financial YouTube and online forums. There, analysts and commentators take the complex frameworks of legendary investors and extrapolate them to their most dramatic conclusions. The $7,000 figure isn't a forecast. It's a theoretical calculation. It's an attempt to answer the question, what would the price of silver be in a world of extreme monetary crisis? This scenario is built on a few key ideas, many inspired by Dalio's own principles, even if he never applied them to silver in this exact way. The first concept is the normalization of the gold-to-silver ratio. Historically, this ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been much lower than it is today. For centuries, it hovered around 15-1. If gold were trading at, say, $2,000 an ounce, a return to that historical ratio would imply a silver price of over $130. During moments of intense financial stress, that ratio has compressed even further, causing silver to dramatically outperform gold. The second, more extreme calculation involves the U.S. money supply. This argument suggests that in a true currency collapse, the value of all the U.S. dollars in circulation would seek a home in a limited amount of real, tangible assets, if you were to back the trillions of dollars in the system with the available ounces of investable silver, you could arrive at a valuation of thousands of dollars per ounce. This isn't a prediction. It's a thought experiment about what happens when a fiat currency fundamentally breaks. So creators took these hyperinflationary models, combined them with Dalio's well-known warnings about currency debasement and debt, and connected the dots. They used his name to add weight to a scenario he never personally outlined. It's a powerful marketing tool. Ray Dalio's ideas lead to $7,000 silver. It's catchy, it's compelling, and it's not entirely wrong that his work points to systemic risk, but it's a huge leap from his actual analysis. The danger here is that it's a distraction. By focusing on a sensational lottery ticket-like price, we risk ignoring the far more practical and urgent warnings that Ray Dalio has been shouting for years. The real story isn't about a speculative bet, it's about a fundamental breakdown in the way our economic world works. To understand what Ray Dalio is truly worried about, you have to understand his most important concept, the long-term debt cycle. While most of us think in terms of short-term business cycles of boom and bust that last 5 to 8 years, Dalio argues there are much larger, 50 to 100-year cycles at play. And right now, he believes we are at the very end of one. Here's how it works, in simple terms. Credit lets us spend more than we earn, which fuels economic growth in the short term. When the economy slows, central banks lower interest rates to encourage more borrowing, creating another boom. Each of these cycles, however, ends with a little more total debt in the system than the last one. Think of it like a person who keeps transferring balances from one credit card to another, taking on a bit more debt each time. For a while it works, but eventually the total debt becomes so massive that the old tricks stop working. This is the end of the long-term debt cycle. It's the point where debt burdens are so large that central banks can't stimulate the economy by lowering interest rates, because rates are already at or near zero. The debt can't be paid back, and the system freezes. Where is the United States today? As of early March 2026, the U.S. national debt has exploded past $38 trillion. That's over $116,000 for every single citizen. The government is adding to this debt at a staggering pace, with interest payments alone now costing more than the national defense budget. This, according to Dalio, is a classic late-stage economy, the final, most dangerous phase of the cycle. When a country reaches this point, it has only a few ways out, and none are pleasant. Dalio identifies 4 levers. 1. Austerity spending cuts. 2. Debt defaults and restructurings. 3. Massive wealth transfers from the rich to the poor. 4. and the easiest, most politically tempting option, printing vast amounts of money. History shows that governments almost always choose option 4. They print money to pay their debts. This is what Dalio calls a monetary inflation or a currency devaluation. It doesn't get rid of the debt. It just makes the money used to pay that debt worth less. Your dollars, your savings, your wages, they all start to lose their purchasing power. This is the core of Dalio's warning. It's not about one asset rocketing to a specific price. It's about the very foundation of our financial system, the US dollar being systematically weakened to manage an unpayable mountain of debt. His famous phrase, "cash is trash," isn't just a catchy slogan. It's a dire warning about holding wealth in an asset that is designed to be diluted. Let me pause here for a moment. This is a complex topic and it's easy to feel overwhelmed, but understanding this framework is absolutely critical to protecting your wealth in the coming decade. If you're finding this analysis valuable, do me a favor and hit that like button and subscribe to the channel for more breakdowns of the economic forces shaping our world. What are your thoughts on this debt cycle? Do you see it playing out? Let me know in the comments below. So if the 7000 silver claim is a myth and the real threat is a systemic currency devaluation, what is Dalio's actual advice? What is the secret bet he is truly making? The answer isn't a single bet on one asset. It's a strategy of radical diversification designed to survive what he calls the changing world order. Dalio's famous all-weather portfolio is built on the idea that you can't predict the future. Instead, you should own a mix of assets that will perform reasonably well in any economic environment, whether it's high growth, a recession, high inflation, or deflation. But in this specific late-stage debt cycle environment, Dalio has become increasingly vocal about one asset in particular, gold. In recent interviews, Dalio has said that gold should be seen as the second largest reserve currency, not just a speculative commodity. He's essentially calling it money. He argues that as global confidence in U.S. government debt fades, central banks around the world are quietly shifting their reserves out of dollars and into gold, an asset with no counterparty risk that has preserved wealth for millennia. He has recommended that investors consider an allocation of 5% to 15% of their portfolio to assets like gold or even Bitcoin, specifically as a hedge against this monetary inflation and geopolitical risk. This is his version of a secret bet, not a secret at all, but a publicly stated, logical response to the mathematical reality of the debt cycle. So where does silver fit into all of this? While Dalio himself has stated a preference for gold, silver's unique properties make it a fascinating proxy for the same thesis. Silver is often called poor man's gold for a reason. It shares many of gold's monetary characteristics but at a much more accessible price point. But silver has a powerful second dynamic that gold lacks, a massive and growing industrial demand. Well over half of all silver consumed annually goes into industrial applications. It is an essential component in solar panels, electric vehicles, 5 grams networks, and even AI server hardware. As the world pushes forward with the green energy transition and technological advancement, the demand for silver is structurally locked in and set to grow. This creates a powerful pincer movement. On one side, you have monetary demand as investors seek a hedge against the very currency debasement that Dalio warns about. On the other, you have surging industrial demand from the technologies of the future. This is happening at a time when silver supply is incredibly tight. The silver market has been in a structural deficit for years, meaning demand has outstripped new supply from mining. Reports from late 2025 indicated the market was headed for its 5th consecutive annual deficit. Unlike gold, which is mostly hoarded, a significant amount of silver is consumed and used up in industrial processes, making the available above-ground supply much smaller. This is the real story of silver. It's an asset caught between the unstoppable forces of monetary debasement and technological revolution. Its smaller market size, which makes it less suitable for a giant fund like Dalio's, is exactly what gives it such explosive potential for individual investors. When a wave of investment capital hits the small silver market, the price moves can be far more violent and dramatic than in the much larger gold market. So let's bring it all back. Is Ray Dalio secretly betting on $7,000 silver? No, that figure is sensational fan fiction inspired by his work. Focusing on that number is like staring at the color of a tidal wave while ignoring the earthquake that caused it. The real shock isn't a price target. The real shock is the revelation that the global monetary system is in the final stages of a long-term debt cycle, as described by one of the most successful investors in history. The real shock is the mathematical certainty that unpayable debts will eventually be handled through currency devaluation. The real shock is that the money you are working for and saving is being systematically engineered to lose its value over time. Ray Dalio's actual bet is on this historical process. His strategy is to prepare, not to predict. He is allocating capital to hard assets like gold that cannot be printed and that will hold their value when paper currencies fail. The story of silver is a direct extension of this thesis. It's the vehicle through which many investors are choosing to protect themselves. Silver's dual role as both a monetary metal and an indispensable industrial commodity places it at the epicenter of two of the greatest trends of our time, the Great Debasement and the Great Technological Transition. The future of silver won't be determined by speculative headlines. It will be determined by the cold, hard math of debt, by the unyielding laws of supply and demand, and by the slow, grinding erosion of faith in fiat money. The 7000 silver prediction may be a myth, but the economic storm it points to is all too real. And as Ray Dalio has been warning us for years, that storm doesn't send invitations, it sends signals. The question is, are you listening? Thank you for joining me on this deep dive. If this analysis has given you a new perspective, please consider subscribing and hitting the notification bell so you don't miss future videos where we explore the hidden forces driving our economy. The world is changing fast, and staying informed is the best investment you can make. Thanks for watching.